Well, private credit LITs potentially promise the best of both worlds. Steady private credit returns wrapped in the convenience of daily ASX liquidity. Buzz, but is all that it seems or not? Let's break it down. Patrick William joins us from Rixon Capital. Patrick, welcome. So, private credit listed investment trusts, what are they?
So essentially it's a listed vehicle wrapped around unlisted private credit assets. So effectively, the fund lists its units on the ASX and allows investors to trade between themselves. That's fundamentally what it is. So the messaging of the market is you get the best of both worlds, to your point. You get the risk-reward proposition of private credit in Australia, and you get the daily liquidity of a listed structure. I argue you don't actually get the best of both worlds.
What, you get the worst of both worlds? What are you saying? So let's talk liquidity then. I mean, clearly that is an issue with private credit.
Yes.
Investors are concerned perhaps their money's going to be locked up. So what does an LIT in that space offer?
Yeah, so it's important to note there's a big difference between how a listed corporate and a listed LIT work on an exchange. So a listed corporate, your Borrells and your BHPs, whatever. They've got institutional investors, they've got fund investors, passive and active, and they're in indices. So there's a deep pool of investors. So if you're a mum and dad investor trying to get your $100,000 out, you'll probably get it out at a very tight spread. LITs, on the other hand, are a very specialized asset class. They don't sit in indices. The funds and the instos don't invest in them either. So it's basically a bunch of mums and dads buying and selling amongst themselves. So if you look at the data, a $500 million LIT will trade like a $50 million market microcap. So it looks liquid, but if you're trying to get your $100,000 out and the price is $1, you're probably getting it at $1.98.
So essentially become a victim of that market sentiment.
That's right.
Whereas the fundamentals perhaps, they don't apply as much.
That's right, because if you invest in an unlisted fund, you put $100 in, you get a 10% yield. If you want your money back, liquidity is quarterly, but you're getting $100 back at the end of the quarter. Whereas the listed structure, you might be able to get it back at the end of the day, but you'll take a 2% loss to do it. And I argue that doesn't make that liquid. You're actually getting a liquidity discount. You're probably better off the illiquidity premium instead.
So how popular are they here on the local market?
Extremely popular.
Well, and becoming more so given the interest in private credit more generally?
More so because of the hybrid market coming off. So you've got all these investors who do like the yield, particularly retail. So look, it is a neat product. It's listed. It allows retail investors to get access to high quality debt. But my argument is if you're a wholesale investor and you don't need that immediate liquidity, you're far better off in an unlisted credit fund.
For a wholesale investor. But of those retail investors then, you're saying exercise caution.
Yeah, it's not as exercise caution. Look, it's a good asset class, but it's not as good as hybrids are, because what people forget is, particularly bank hybrids, they are traded by the banks and the funds. So you will have liquidity in a traded hybrid, and the hybrids tend to be franked as well. So you're getting a slightly higher return, lower return, and less liquidity with something that on paper looks like a direct replacement to hybrids. So
in terms of the wholesale investor, where may they be better off being rather than an LIT?
Well, if you're a proper wholesale investor, if you need your money back quickly, you're better off in a cash management trust for a few weeks. But if you're looking for something medium term, you will get a higher risk adjusted return, and you'll get that quality liquidity with an unlisted fund without your capital value fluctuating. So my advice would be, you probably should take a really good look at an unlisted fund and compare the cost benefit.